Warren Buffett's 5 best tips for investors that do not follow the stock market. I'm not a financial advisor. Always do your own due diligence before investing. Warren Buffett occupies most of his time studying companies to invest on. But he understands and advises that picking individual stocks is not for the majority of people. The Oracle of Omaha explains the way that everyone can invest and collect profits. The first tip is to buy S&P 500 index funds. This way an investor is just riding the market, which yields a 10% yearly return in a 30 years average. 10% return is 20 times better than the best savings account out there that today is giving 0.5% return. If you enjoy finance, making money, saving and investing, please drop a like, and if you are new here, subscribe, hit the bell and share this video with a friend. And tip number 2 is to keep the fees low. Many people pay somebody else to invest for them. And these people that get paid to perform well have so much stress on top of them that they end up most of the time underperforming the market. Today we can invest our own selves using free trading platforms like M1 Finance or Webull. I don't work for these platforms and they don't pay me to say this, but I wish they did pay me. If you want to open one of these accounts, you can use my links in the description down below. It's completely free, and after you deposit $100, Webull will give you 2 free stocks, and in case you use M1 Finance, you'll get a $10 bonus. You can go directly to their webpage or you can use somebody else's link, but if you use my links, you get those bonuses and I also do get a small commission. M1 Finance will even allow you to use fractional shares. So even with small amounts of money, we can start investing today and start collecting compound interest. And Buffett's third tip is to pay off credit cards debt before investing. People always ask me, should I pay credit card debt first or should I invest first? And the answer for this varies from situation to situation. But most of the time, the best approach is to pay credit card first because most credit cards will charge 18% interest, sometimes 25% interest. But if instead we are investing to collect 10% or maybe 20%, it's not enough to make it worth it because the credit card will be charging almost 20% or more guaranteed. Let us know what you think. Add on the comment section down below any questions, comments and ideas. And the fourth tip is to practice dollar cost averaging. This means investing smaller amounts throughout a period of time instead of waiting for the perfect day and timing the market. Buffett does not like to time the market. I think nobody times the market. People say they can time the market, but it's just impossible. We can only know when the stock market peak or the lowest bottom of the dip is after we already passed it, and then we can look back and say, oh, that was the peak and that was the dip, but by then it's too late. There are a few clues that we can look and take advantage of to avoid peaks and invest during dips, but in reality no one has a crystal ball. Maybe some of us have a crystal ball, but it doesn't work. All the best experts we have already predicted 50 of the last 3 market crashes we had. And finally, the Oracles of Omaha tip number 5 is to invest for the long run. The market is full of volatility, we can make people anxious. But Buffett himself has set up a great example. He invested during World War I, World War II and everything in between. 75% of the time the market is on an upward path. This is what I found on the Fool.com. Warren Buffett's 5 best investing tips for people who don't follow the stock market. The Oracle of Omaha believes you can beat most hedge fund managers even if you're not a stock market expert. One investment strategy that the Oracle of Omaha would approve of? You don't need to spend hours scouring financial statements. Warren Buffett has a pretty simple strategy that he thinks is the best way for the overwhelming majority of people to invest. Here's how the legendary of Berkshire Hathaway thinks you should invest even if you don't follow the stock market. Number 1, Buy S&P 500 index funds. While Buffett is without a doubt the world's most famous stock picker, he doesn't think most people should invest in individual stocks. For years, he's embraced S&P 500 index funds as the best way for most Americans to build wealth. By investing in an S&P 500 fund, you become an automatic investor in all 500 companies whose stock the index tracks, including Berkshire Hathaway and many of its top holdings like Bank of America, Coca-Cola, Apple, and American Express. Buffett has left instructions in his will stating that 90% of his personal wealth should be invested in S&P 500 index funds. The remaining 10% will be placed in short-term U.S. treasuries. Although Buffett is a long-time proponent of index investing, for most people, Berkshire Hathaway only recently added 2 S&P 500 funds to its portfolio. In February, its 13F filing revealed that it had purchased shares of the Vanguard S&P 500 ETF and SPDR S&P 500 ETF. Though combined, the funds still make up less than 1% of Berkshire Hathaway's holding. Number 2 is keep the fees low. Most fund managers who try to outperform a broad index like the S&P 500 will underperform in the long run, as Buffett frequently points out. That's why he loves to slam fund managers who charge high investment fees in spite of a not-so-stellar track record. Buffett famously wagered $1 million that an S&P 500 index fund could beat 5 hedge funds over 10 years. He won the bet and donated the winnings to charity. 1 year earlier, he predicted his win in his 2016 letter to Berkshire Hathaway shareholders, and fund managers' fees were a major factor. When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients, Buffett wrote. So when you invest in S&P 500 index funds, look for one with the lowest expense ratio possible. The lower the expense ratio, the more of your money actually goes into the investment. For example, if you invested $1,000 in a fund with a 0.1% expense ratio, $999 of your money would be invested and the remaining $1 goes toward fees. In case you were wondering, the Vanguard and SPDR funds Berkshire Hathaway owns have expense ratios of 0.03% and 0.09%. And number 3, pay off credit card before you invest. At Berkshire Hathaway 2020 shareholding meeting held virtually in May, Buffett was asked about the state of the credit card industry. He used the occasion to remind the world of high cost of carrying credit card balance. Even though Berkshire Hathaway often profits from credit cards, given its heavy financial sector holdings, Buffett told the story of a friend who sought his advice about what to do with her money. He asked her if she had credit card debt. She did. With a APR of 18%, Buffett told her that the interest savings from paying off the credit card debt would be far greater than she could earn from any investment. I don't know how to make 18%, Buffett said. And number 4 is practice dollar cost averaging. Buffett isn't a fan of market timing. In February, at the start of the coronavirus pandemic, he told CNBC, "You can't predict the market by reading the daily newspaper." Like his mentor Benjamin Graham, Buffett is a proponent of dollar cost averaging, in which you invest regularly at fixed intervals, no matter what's happening in the stock market. So, when he recommends funds that track a broad-based index like the S&P 500, for most investors isn't with a caveat. Don't put your money in all at once. Do it over a period of time. And finally, number 5 is invest with a long time horizon. Some of Buffett's greatest words of wisdom are about the importance of long-term investing. Regardless of whether you follow his advice and stick with passively managed index funds or pick your own stocks, he suggests you ignore short-term results and focus on 4 and 5 year averages. As long as you're invested across the stock market, Buffett believes you can count on good results over time. As he put it in his 2016 letter to Berkshire Hathaway shareholders, American business, and consequently a basket of stocks, is virtually certain to be worth far more in the years ahead. Avoiding investing fees, paying credit card debt, not trying to time the market, and investing for the long run do sound super beneficial. In my opinion, these advices are good for all investors. Thank you so much for watching this video. Have a wonderful day.